Sydney. Leanne, great to have your company. Just in terms of that Telstra deal, interesting to see that the shares opened stronger and now have lost all that ground, down 0.4%. Investors not liking this deal?
Ingrid, you're absolutely right. It is certainly interesting. We are seeing that share price in negative territory. In our mind, actually, it looks fairly positive. If we look at the price that they have paid for it, it does look like it's actually below the average that we would actually see for some of those telcos in the Asia-Pacific region. There has been some speculation recently that they were looking to acquire it for about $1 billion or so, but it does imply an earnings multiple of about 6.3 times, and that's based on the earnings of Pacnet of about $111 million at the end of December 2013. The average within that sector across the Asia-Pacific region is about 7 times. So it does actually look like the price they've acquired it for is quite good. And as you did mention, it certainly is in line with their strategy to start expanding outside of Australia. And of course, Asia is one of the areas that they are focusing on in terms of their growth prospects. So certainly mirroring a lot of the commentary that they did come out with at their AGM recently. So despite seeing some of that positive outlook in terms of this acquisition, in terms of expanding those opportunities, picking it up for quite a good price, it's certainly interesting that share price is under a bit of pressure, but I think that is a reason, or possibly a reason, could be that investors are a bit disappointed. It is going to leave the company with less cash in terms of returning it to shareholders in the form of, say, buyback or special dividends. So potentially the reason we are seeing that share price under a bit of pressure. Telstra obviously recently has really been continuing to surge, trading at 13-year highs at the moment, and of course that was following some of those announcements last week in terms of those NBN payments, which certainly looked very strong. So seeing coming off a little bit today, not surprising, maybe seeing a little bit of a breather after those record highs, but as I said, in our mind that acquisition actually looks fairly positive long term.
Okay, let's talk about Atlas Iron, because this one is defying the market weakness today. It's up about 3.5%. What's driving it stronger?
It certainly is. It's quite interesting. It's actually the one that's leading that materials sector higher, and of course this is following some of that commentary yesterday by the Western Australian government saying that they will actually be providing some of that royalty relief for the next 12 months or so, subject of course to that iron ore price remaining below 90 Australian dollars a tonne. So I think we are seeing a bit of a share price surge off the back of that commentary. I think potentially it is going to benefit some of those junior higher cost producers such as Atlas Iron. Certainly we know that the company has been taking steps recently in terms of reducing their costs, given that they are of course the highest cost producer. They have a break-even price at about $82. So at the moment they are actually loss-making. At their investor presentation recently, the 11th of December, they actually did announce that they were increasing their cost reduction target and they were cutting about 80 jobs or so in an attempt to save about $15 million. They also provided a fairly strong trading update for the month of October, saying that there were record shipments there, some of their costs are trending lower, and those Horizon 1 assets were performing quite strongly. So there was quite some fairly positive news coming out of that investor presentation. So looking at those positives and also those royalty payments coming through, I think the outlook still remains very concerning in terms of that iron ore price. Obviously they are very highly leveraged to further weakness in that iron ore price, and of course, as I mentioned, being the highest cost producer, also those Horizon 2 assets which still require a port and rail solution also remain a bit concerning. So I think despite actually seeing those royalty payments coming through, which should potentially help in the short term, I certainly think medium to long term the outlook still remains a bit cautious.
Broader market, Leanne, today losing that Santa Claus rally really. We're now down 0.8%, so also extending those losses, in fact down below the 5,400 mark.
Unfortunately, we are seeing a bit of a breather on the market today, Ingrid. Of course, previously seeing those 4 days of gains. So not surprising, we are seeing that materials sector and obviously the energy sector coming off some of the recent bounce that we have seen in those shares. Of course, overnight we did see commodities falling quite sharply in terms of iron ore, copper, and of course gold as well. We are seeing the likes of BC Iron and Northern Star coming under a bit of pressure. And of course, in that energy space as well, we saw West Texas Texas oil down about 2.8%. And as I mentioned, falling off following a sharp or a small bounce that we did see yesterday. We are seeing all of those stocks in that energy sector in negative territory, except Whitehaven Coal. In fact, the best performer, or the one that is trading relatively flat, is still remaining that healthcare sector, potentially in relation to that Aussie dollar. Of course, overnight, following the weakness in those commodity prices, we did see that Aussie dollar continuing to fall, and of course off the back of that US dollar continuing to increase. So potentially why we are seeing some strength in that healthcare space. But as I said, going to be a fairly quiet day given some of the around the region. Of course, the Japanese market is closed, so potentially expecting some lighter volumes going through today, but certainly taking a little bit of a breather.
All right, Leanne, we'll leave it there. Thanks a lot for joining us.
Thanks, Ingrid.
Leanne Jones from